So on the monetary side, I've had this strong view on inflation, and we've debated this, for a few years now, that RBI has been consistently getting its inflation forecast wrong. So if you take the last 24 months average inflation, it's around 3.7, and RBI's target was 4. For the first time this year, they gave quarterly numbers of average inflation, and they've undershot by about 50 basis points for the first 2 quarters. They have guided lower by 100 basis points for the second 2 quarters. And we are at calibrated tightening. That's our stated position. It seems very strange to me. I can understand if the central banker believes in tightening for currency stabilization. That they have very clearly said is not their mandate as far as monetary policy is concerned. Then I really don't know why we are where we are today. And I go back to real interest rates, which are at almost 4.5%. And Urjit Patel himself wrote a 80-page report in 2014 highlighting how the anchor for monetary policy should be real interest rates. And Rajan went on to say that 1.25 to 1.75 is the neutral rate for India. We are at 4.5%. Nobody's talking about real interest rates. So I really don't understand what RBI is doing. I'm completely at loss. And I'm hoping that so I actually also blame RBI because the Monetary Policy Committee decides rates based on the data that's given to them. And I can prove consistently for the last 3 years that the data that RBI has been providing is wrong. It's not error. I think it's completely wrong. So I really don't know. So I don't know whether, the new governor comes in. He may be still fed with wrong data. I hope they look at the data that they're getting. So I do believe there is a lot of room for, monetary easing. And I hope that some of that comes through.
Yeah, no, but how will you approach as a market participant? I mean, you have to
I do believe that there is room. So I would believe that now that...
So you buy financials. Is that, I mean, what I'm asking is...
Yeah. So as a house, we are long financials anyway for many other reasons. Now that, even the new governor is sort of indicating, and even the previous governor indicated that there could be room. I mean, we're at 2.3% inflation, and it isn't looking as if for the next 6 months we're getting to 6 or something. It is going to be in the range of, from here to 4. So why are we so tight? I really don't know. So I leave it to the judgment of the experts here, but I do believe there is room. So financials is a good space.
Okay, the last 2 days, the theme in the market has been to buy stocks which suffered under the previous RBI regime. There's no other way to put it. Just look at what's happening to Equitas and Ujjivan now. We've seen Yes Bank, Bandhan Bank. Now, just look at the move in Equitas, and that's the one which is now surging 4.5% higher, just one-way rally. Ujjivan is now up 9%. It's a massive move happening right now in some of these stocks. Sridhar, good morning.
Good morning.
Good risk reward here. I mean, at the end of the day, in market, it's about making money.
These are short covering rallies, so I wouldn't, take a structural bet on these. If I like them, I would want to buy. But because something is going up, because a governor has changed, that is obviously a short-term view. And given, as you mentioned, there are a lot of shorts sitting in the market, and many of them are covering right now. But is there opportunity in the financials? Yes, I mean, we do like financials.
But which one? Would it be only corporate banks?
So at this stage, corporate banks is our large trade. We think there is easy money to be made there because one, their credit costs have been very high for the last few years, and we're already seeing that coming down. We think it will sort of normalize in 1920 and significantly normalize the year after that. So we're going to get significant bump ups. We are not even factoring that there is going to be any benefits from IBC. We are assuming that there'll be gains in some, there'll be losses in some of the others. So it sort of neutralizes. We are not taking any benefits of IBC. We are just playing on the fact that the growth is coming back for the banks, and credit costs will normalize. And the third is that given that NBFCs have ceded some space, especially in the in the smaller and mid corporates, that benefits some of these banks. So all in all, I see good opportunity for corporate banks in general.
Okay, so corporate banks is something that you're positive on, but you were telling me yesterday that, NBFCs, the entire space is what you're cautious on,
Very
especially
much.
housing finance
Correct.
companies.
Yeah.
Is it to do with the liquidity pressure that we've seen, or what are you worried about?
So my concern is more on the asset side, and that has not yet played out. So if you take any of the HFCs, the average HFC, I'm not wanting to name any particular HFC here. Broadly, about 40% is builder and lab combined. And tell me one HFC which has declared a large NPA on builder loans. You can't remember any of them, right? And when it comes to banks for the same sector, about 15% is NPA. So how is it possible that banks have 15% NPA and the HFCs don't have? And the reason is that the HFC norms are very lax. An HFC can restructure a builder loan, and the NHB guidelines doesn't provide for any disclosure. So I, as a minority shareholder, I never come to know if you have restructured anything. In fact, I was working very closely with the previous NHB chairman, trying to improve disclosures, and for whatever reason, it never happened. So I think there is a lot of NPA sitting in HFC books, especially in these two categories.
That would be true of NBFC also, no?
It will be true for NBFC. My only reason for HFC is that there is some oversight of RBI as far as NBFCs are concerned. For an HFC, it is NHB, which we know is a very weak regulator. So the probability that there is more NPA sitting there, and in fact, I heard Arvind Subramaniam yesterday in one of his interviews, and he said there is a need for an AQR for NBFCs and HFC, and I completely agree. If these companies are asking for support from Reserve Bank, then
they better clean their books.
You better clean it up. And we should not allow this crisis to go waste. So if we just provide liquidity and do nothing about cleaning up, so the good thing about banks is that the banks have got cleaned up today. And you go back 3-4 years, we always used to say adjusted book because we never believed in the NPA. Now that is like 90% we would know is known, is very well known. That is not the case with HFCs and NBFCs, and particularly HFCs because the regulator is very weak.
So are you expecting a lot of builder loans to blow up? I mean, is that the other part of the market that could be under pressure, the real estate space? Because we keep hearing about a big crunch in liquidity over there.
There is a big crunch in liquidity. And even for NBFCs, there is a crunch as far as liquidity is concerned. The rates have gone up. The securitization rates have gone up by 200 to 300 basis points. Nobody will come and say on the channel, but when you actually go and meet these NBFCs, so they are having significant issues on liability side. We will see the impact of that when we see the third quarter results. So there is an issue. So I really don't completely, I'm not in RBI's camp that there is no issue. There is an issue, but I hope that the issues are resolved along with some sort of AQR, which will be the best for the industry.
Okay, so outside corporate banks, what else is good? Would you go with the capex cycle? Yesterday, IIP numbers were good, L&T numbers were good, Cummins was good. Is that the other one you're looking at? And consumer, if rates are falling, who else benefits?
So consumption is a theme because typically closer to the election, we do get some increased spending by the government. Also, election itself is a large spending event. Keep in mind that on an average, every individual candidate who spends at least 20 to 40 lakhs minimum, and in high profile it's even higher. Just keep multiplying that. So the velocity of money typically
in election quarters you see consumption.
Substantially it goes up. So I do expect that consumption will improve from here. So it could be discretionary more than staples because that's where the extra money comes. So discretionary as a segment does look interesting. Durables, in general, consumption will improve. So that's a theme that we like. The other thing is, of course, the entire construction, road building, that sort of theme, we've been very positive. Some of them have corrected very sharply. That is something which we like because that's been one of the ministries which has done well. And yesterday, Mr. Fadnavis was there in one of the conclaves, and he mentioned how 50% of the large capex is coming from the Maharashtra region because of the large capex that is happening in this state. Okay. All that benefits this segment. There's enough order book floating around right now. So we are reasonably positive on, especially so we're positive on the domestic segment, not so much on the
export oriented.
Okay, that was my next question actually, Sridhar. So I'm assuming you would say that perhaps take some money off. IT has had a big rally. Mid-cap IT, you think still has some bets?
So IT is very stock specific, but this year the entire sector has done very well.
Yes.
Probably because of the way the market has moved, also the currency has moved. But if I take a structural, say, 2-year, 3-year view, and if I look at IT, have they done enough to create, new business models where they are building new IPs? Look at what is happening to Chinese IT companies where they are building IPs on, say, AI or robotics. I don't think we've done enough. So this has become more like quarter-on-quarter movement, trying to get some of the low-hanging trades that IT is doing. So,
but what's your view on the market in general? I mean, from now up until the elections, you think there's going to be a lid on the market in terms of an upside, or which way do you think it could swing?
So I am positive on the market for next year. So I go back to 2013, and we had a lot of uncertainties even in 2013 entering the election. And I think the good part is even then the macro was improving. You go back to Rajan's stint at that point of time and how inflation started to improve. We are seeing similar, which is the macro is improving. I really don't know what happens at the elections, but typically when the macro improves, the markets tend to follow. So I would be positive for 19. The building blocks are very much there. We haven't had earnings growth for a while. So the possibility that the market starts to discount all of that, and we're already climbing a lot of wall of worries, and we may continue to do that despite the uncertainty as far as the election is concerned.
Okay. Well, the grief expressed over growth, or the worries expressed over growth, are one that global growth could be slowing, going by the way. Even Jerome Powell shied away from a very hawkish stance. And secondly, that the the NBFCs were funding something.
Yeah, of
and
course.
the PSUs will not be able to step in immediately. Therefore, do you think, your best expectations for earnings could be a distance away?
It could be. I think if I go back to commentary after the first quarter of this year, I mean, companies were really giving very positive commentary. Post the ILFS NBFC crisis, a lot of that has got, muted. But I do think some of it is coming back now. And as I said, once the spending comes closer to the elections, a lot of things change. So it's a question of the liquidity in the market and the spending. I do think that that starts to happen sometime in Jan, Feb, March. We will see that to happen. So that will take the.
I mean, look, Sonia follows autos very closely. That's been giving you this lead indication that something has slowed. Though, of course, like we were discussing earlier today, IIP, PMI, all that is indicating still robustness. So, I mean, is growth a worry or is it not a worry? We get two different narratives.
No, it is a worry, and I think it is linked to some of the NBFC issues also, because NBFCs, whether we like it or not, were 1/3 of the incremental credit to the system, and they were providing credit to many of these discretionary spending to a large extent, and that has slowed down. We do think that some of this will come back as we enter the fourth quarter.